Welcome back. You're still watching Business Morning on Channels Television, and we're broadcasting live from Lagos, Nigeria. Well, today on the program, we'll be looking ahead of the MPC's decisions. As we know, the Monetary Policy Committee of the Central Bank of Nigeria has been meeting for 2 days now, and today we should get a feel of, or we should get to hear the decision on some key issues. And of course, the markets and investors are actually anticipating and anxiously waiting for the outcome of this meeting. And to talk about what the possible outcome of the meeting should be like, and if eventually it does come to either negative or positive, as the case may be, how will the market react? How should investors react from here on? Well, I'm being joined on the program by an economic analyst, Gabriel Idahosa. Mr. Idahosa, thank you so much for coming this morning.
Thank you.
Now, this is the first meeting that will be held, post the suspension of Mr. Sanusi, Lamido Sanusi, and it should be that the immediate priority of, even though it's an acting capacity, by the acting CBN Governor, Dr. Sarah Alade, it should be their immediate priority to reassure the market that the Nigerian growth and reform story is still very much on track. Now, what direction is the committee likely to take, bearing in mind the stability that was shaking when Mr. Sanusi was suspended?
Actually, the new governor, immediately she was appointed.
That's the acting governor.
The new acting governor, when she came in, she took an immediate step to address that. She came out with a statement essentially saying that policy will be on course and that they are going to continue the essential focus on the stability of the Naira, and that they will ensure that all these processes of attending the buffers that are being shaken at this time from the excess crude draining that is going on, the tapering that is affecting us, the issues that are recognized by the CBN and the new management, and that the policies will not significantly change. And when you see that the MPC composition is more or less the same, you will expect that they will maintain the same stance in most things. So you are not likely to see any dramatic changes in what the MPC does or what the acting governor does.
All right, but at the last meeting in January, there was this speculation after that meeting actually that there was going to be an increase on the public sector, the CRR on public sector deposits from 75 to 100%, and also an increase on private sector deposit funds from 12 to 15%. Let's just talk about the implications to the bank if this was to happen.
Well, of course, it will further reduce credit capacity of the banks. The banks can only give credit from the deposits they hold. But it's almost certain that the CBN will move the 75% for public sector to 100% in view of the pressure we are all seeing on the foreign exchange. But when it comes to the private sector CRR, the MPC may want to take a hard look at that before making any increase, because you don't want to dry up all sources of credit to the economy. If you want the economy to continue to grow, you must provide some means for the banks to provide credit. So we are likely to see clearly the 100%. That's one of the last options the MPC has to stem the pressure.
Yeah, but you say if you now increase that, and as much as possible, we want to see growth in the real sector, which is supposed to be the driver, the key driver of the economy, that is. Now, if there's an increase in public sector deposits and private sector deposits, and then banks' ability, to access credit is reduced, how then will they give credit to, for instance, entrepreneurs, businesses, and the rest of it who require credit to fund their business? Now, bearing in mind also that this also will now affect the rate at which they're going to be lending. So at the end of the day, are we not stifling growth where growth is expected to come from?
Well, I think that thinking is strong on the side of the private sector deposits. The private sector deposits should form the bulk of credit resource for the banks.
Not the public sector deposits.
Now, the public sector deposits has always been controversial. The handling by the banks in the first place was questionable because it was a case of the government giving, let's say, 10 billion to the banks and then coming around to borrow 9 billion to pay salaries and all of that. So it's not really been a source of significant credit for the banking system. It's a long-term, reliable source. It's unlike the private sector where people place their savings, where insurance companies place their deposits, pension funds place their deposits, and they are there for reasonably long periods of time for the banks to use them. So the real question is whether the MPC should touch the CRR for the private sector deposits. Yeah. And that really addresses your question. They should be very reluctant to do that. They should, as much as possible, avoid having to increase the CRR for private sector deposits so that the banks will still have sufficient room to grow the economy by providing credit. But if they have to do that, it's because they are run out of solutions. They run out of several options. At 12%, it's very difficult for them to justify any further increase in the MPR. So they are more likely to say, well, the 100% public sector deposits is there, let's take that out. And what else can we do? They are going to have to start to find any other things to do. But if they have to cut, if they have to further increase the CRR for private sector deposits, it means they are really getting to the end of the road in terms of any options available to them, other than now allowing the Naira to begin to gradually find a new level.
Now, we'll get to that in just a moment, but let's still talk about this for a little while longer. Even though it's going to affect the bank's credit capacity in terms of lending to the public, how is it going to affect their own books, for instance, their top and bottom line? Because they're in this to also make profit as much as they are in this to give a service. So how is this also going to affect their top and bottom line?
Well, it's already affected. You look at the results coming out for 2013, most of the banks are either flat or in some cases have actually gone down, both top line and bottom line. It was known that it was going to affect them because as a bank, the raw material you have are deposits that come in from private or public sector. If the CBN says now you can't touch public sector, it means perhaps half of their sources of deposits are gone. So they have a smaller area to play with. And what that means is that banks that are very creative in trying to drive private sector deposits, in going beyond their current areas of focus and looking for more geographically and sectorially more private sector deposits are likely to be the winners. But banks that have been significantly dependent on public sector deposits are going to see their results coming further down this year.
Now let's look at how this might likely affect the market. Yesterday, the Nigerian equities market actually finished in negative territory, was down about 0.50%. And like you heard the stockbroker this morning wrote to me saying that it was as if investors are treading cautiously. They're actually waiting for the outcome of this meeting before they begin to take any decisions. Although some say this is the best time to actually start buying. But in the eventuality that the results do come out, and like he said, if it's up, there's a possibility that the market will be negatively affected. How much of a negative impact are we going to be seeing on the market?
Short term, it may not be very strong because the market has already absorbed some of it. If you look down from January to now, the market has been coming down, recognizing all these facts that stare us in the face. In any case, from December, it was obvious that tapering was going to come and it was going to affect foreign portfolio investments. A lot of the foreign portfolio investors are already taking their money out, and so that is going to continue. And so in terms of the effect of the market, it's already started. So you are not going to see a dramatic effect from whatever the MPC decides because the market has been absorbing the effects all the way from December to now. What our investors are looking at, are they going to look at just a decision or a trend? They are more concerned about the trend. Where is foreign reserves going? Are they going to start going up or are they still going down? All the indications are that they are going down because there's nothing to show us that foreign reserves are going to start moving up. Where is inflation? Inflation is good. It may remain there if we do not increase the MPR. So that again those are the things that those kind of indications in terms of pattern or trends are what investors are.
What about the money market?
Money market is already there. Money is going to be much more scarce than it is now. With the 25% left of public monies out of the system, all the banks are going to be scrambling for private sector deposits and savings. So they are obviously going to offer more rates, higher rates for deposit, but in the same vein, they are going to increase their interest on loans that they are charging. And we are already seeing all of that going up. Again, you are not going to see a very significant increase because of this MPC decision, because rates have already gone up.
This is all in the short term?
Yes.
The short to medium term?
Short, medium term, you cannot change, for example, our foreign exchange inflows in the short term. If you want to fight, for example, the oil thefts, it's a 6 months, 1 year battle, even if you succeed. And you need to succeed for that to start to change our flows. If you want to increase foreign exchange inflows from agriculture, it's a medium term. You've got to get your farms working. You have to have your harvest to reduce your rice imports, for example, significantly, for you to reduce your foreign exchange you spend on rice. So some of those things are medium term. They will happen in the medium term, just as we have seen in heavy industry like cement. It's going to happen in the medium term. 2 years down the road, we'll probably be importing much less rice, and we're going to save a lot of foreign exchange. Same thing for cassava. But in the short term, 3 months, 6 months, these things are not going to happen. So the MPC does not have many options in the short term in terms of what they can do.